Hello everyone, we are back. It has been a very long time. I decided to take a small break from YouTube. I have a lot going on in my personal life right now, so I decided to go away, step back for just a moment, and come back and bring you guys a monthly update. Now, I don't know my normal posting schedule, if that will be maintaining or if that will be changing, but let's go ahead and show you guys what I finished out with for the month of March, and it was $46,774. This is as of the close of March 1st, and so far we are on pace just behind to reach my $1 million by the age of 40 goal. Based on my birthday, and you can see right here we need it to be about 48,000 to hit that month over month goal to reach my annual birthday amount, but we're just behind by about, let's see, a little under 2 grand or so. Now the main thing I want to talk about in this video, and I'll be giving specific dedicated videos to each and every one of these holdings, is my portfolio holding change. We have had a dramatic shift. And when I say dramatic, I mean absolutely insane shift in portfolio holdings. Last time you guys saw me, I was holding Croc stock. Last time you guys saw me, I was holding Google. I was holding Salesforce. Those are all three gone, and all for their own individual reasons. But long story short, here's the 30-second version of why I got rid of each one of them without going too in-depth. I'll be posting dedicated videos to all of these. But first off, let's start with Google, the smallest one. The main thing that concerns me for Google is ChatGPT and Bing, their new integration due to Microsoft's new rollout of the new version of Bing that is honestly, in my opinion, going to take a small amount of market share from Google. And I think that is overall going to take down investor sentiment of the stock. I think overall this is not a great thing for Google. Last year they managed to grow revenue 9.78%, which is pretty good, but that's dramatically slower than this company's long-term average at around 20%. If you look at the averages down here that I'm highlighting, they cut their growth in half, and now that they have ChatGPT on the back of them, I'm not sure if this company will be growing nearly at the levels I want it to be, and more importantly, the profits that actually shrunk 10% next year. Well, I think that Google has some troubles ahead of it, especially with it being a bit bloated, the excessive share-based compensation, as you can see from these charts right here, that's still growing every single year, and more importantly, it's just one that I'm not confident in the future, so it's one that I've decided to sell out of. The middle-sized one, Google was the smaller one, Crocs was the middle-sized. Crocs was one that I mostly decided to sell out of because of one reason, and one reason only. The stock has went up so much. I bought my shares at $76 a share. I ended up selling the other day when they had their earnings run up at $142, and so that is almost double in share price from where I originally bought it at, and that was in a 6-month turnaround. Technically less than 6 months, it was like 5.5 months. But in 6 months, to have the stock price double, I think that in my opinion, it's time to sell out. When I was buying this company, it was originally trading at PEs around like a 7. Last time I checked, as of today's estimates, I believe it's around 11.5, which that's still pretty low, but to be honest, at the end of the day, they do just sell shoes. So it's not a company that I'm super excited about. It's one that, while it is selling at $70, $80, $90 a share, it's one I can definitely wrap my head around. But do I want to be risking capital buying this stock in the 120s, the 130s, or even the 140s where I sold it at? Maybe, but it's not one that I'm super amped up about. I may end up entering into this position again if it were to go down, especially if we go back to like the 100 range. I could buy a small position again, but for now, it's one that I'm selling out of, frankly, because this company's doing everything in the right way. They're growing great. They're paying off hundreds of millions of debt every single quarter. Just in the last 9 months, they paid off over $500 million in debt, which is absolutely great. And it's one that I'm just, I'm moving on. I'm not dealing with it anymore, and it's one that I'm moving on to another holding. Lastly, this has been the biggest one of all, and I sold out today. You can see as of right now, it's up 11% on the day. I think it was as high as like 17% up at open, before the company dipped at market open. But basically, this company had a roar higher, and it is doing now phenomenal over the last couple of months. Year to date, it's now up 38%, and you can see over the last 6 months, Salesforce has started to recover quite nicely, especially over the last 3 months or so. But this is one that did get hit very hard from a couple years ago at around $300 a share, and $300 was just sky high prices. Now, to be honest, I did have a couple of my positions that were very aggressive on my covered calls. You guys know I like to sell covered calls on all my positions, but basically this is one that got a bit away from me, and it's one that I'm not as excited about being at around the $200 range rather than in the low 100s. When I was really aggressive and trying to buy more of the stock was when it was at its lows, when it was at 150, 140, And heck, at one point it even dropped to the 120s, which is just crazy. But today at 185, 190, it's okay. It's not a wonderful, amazing steal, but it's not anything that's wildly overpriced. It's one that I did get forced to sell out of because of my covered calls. It's one that I really hope drop back down. If it could go back to, I don't know, 175, maybe just off the top of my head, 175 or lower, I could start my position again and slowly buy back in. I may buy 100 shares again if it were to go back down to the 170s, 160s, and we'll see what will happen from there. But for right now, it's one that is very exciting to be in because they are growing and they beat revenue and profitability estimates across the board. But it's one that I'm stepping away from for now. And so far, the portfolio has been doing very good. Speaking of which, I talked to you guys about my holdings and I wanted to give a brief explanation of all three of these. If you look at this, it looks really interesting because first off, this is significantly more concentrated than most people's portfolios. And to be honest, where I'm at in terms of capital, I'm about $50,000 invested. It's a bit more concentrated than I'd like it. I would like a fourth position, probably wouldn't even hurt to have a fifth or sixth in here, but right now I'm only investing in stocks that I find really good deals because I've done good, I've had some good performance. And it's one that I just, there's deals in the market, but there's nothing that's just, wow, I just have to go get it. If you look at M1 Finance here in my portfolio, which by the way, you can get up to $100 for signing up if you use the referral link down below. 134 people have used it so far, so check that out already if you haven't. But basically, if we look at this holdings, you can see 46% in Dropbox, 40% in Amazon, and then 14% in iRobot. And specifically, that's in iRobot calls, which I'll show you that right here. First off, I want to notice that this makes my portfolio look significantly worse than it actually is because really this looks like it's a $6,000 loss, but all that we're doing here is waiting on an arbitrage bet. Basically, an announcement will be coming soon as to whether or not Amazon will be buying iRobot at $61 a share. If that were to happen, now I've done something that's a bit risky here. This trade is either going to do one of the two things. This $9,425 that I'm invested is either going to go straight to zero, literally $0. It's going to be worth nothing on June 16th, or all these contracts will go up to $6 a share. Now let me give you an example here. Let me pull out my calculator. I invested about $9,000. Of these 60 contracts, all worth $6 each, and multiply that times 100 since these are options contracts, that means that this will be worth $36,000. Now I invested $94.25. That means if this deal goes through by June 16th, I will have made profit $26,500, which would absolutely skyrocket my portfolio. Now, will this happen? Absolutely not. It's not guaranteed. Anything could happen, and there's a reasonable chance that this actually does not go through, and I end up losing the full $9,000. That's perfectly fine. I'm ready to walk away from the deal, losing it all, but the upside, in my opinion, is too juicy not to take advantage of it. I think that this deal will go through. I think that iRobot is so small in comparison to Amazon that it's ridiculous to think that it would get held up. And if I'm wrong, that's perfectly okay. I'll lose my $9,000, walk away. But in the meantime, I'm going to keep on counting down the days till this deal is announced. And if it does end up getting closed at $61 a share, your boy is going to be a really happy camper. So I'm really looking forward to that. So that's the smallest position in my portfolio, some iRobot calls, only 14% invested. And next we have Amazon, which is the second out of third largest position in the portfolio. About 40% of my money is invested in Amazon. Now I've went over Amazon so many times on the channel, I don't want to cover this too long, but basically Amazon is one that I'm very bullish on and I think will keep growing, mostly due to not only their top line revenue coming from their big e-commerce business, but mostly deriving from AWS. You've seen these type of spreadsheets before that I made where I break down the North America, the international, and AWS segments, but long story short, at the end of the day, what really matters here is AWS. Their backlog just keeps skyrocketing. I just updated this the other day. They had $104 billion in the backlog for AWS. Now they have $110 billion as of the most recent quarter. That's about a 6% growth quarter over quarter, and that's just on the backlog, not the actual revenue itself. While revenue has slowed considerably, I will have to probably adjust these estimates for 2026. There's so many great things going on with Amazon, and you can see all of these right here. There's so much stuff. enough. And while revenue growth has slowed for AWS, down from originally around 40% down to 20, and I'm not happy about that at all, don't get me wrong. I still think there's a lot more upside for Amazon Web Services moving forward. And then last but not least, one that you guys I bet did not see coming at all is Dropbox. 46% of my portfolio in Dropbox. It was a reasonably large position, and I decided, as you can see it's highlighted in yellow here, I added a bunch more shares today, and you can see that Dropbox, it is a pretty good chunk of my portfolio. Let me rephrase that. It's the huge chunk of my portfolio. It's the majority, 45%, and this is primarily because this company has literally went nowhere. Let's go to their IPO. They're about to hit their 5-year anniversary. They went public middle of March of 2018. We're at March 2nd as of the time of me filming. We're a couple weeks away from hitting their 5-year anniversary. They went public around $28, $30. What does the stock trade at today? 20. Okay, well, we could assume that the business has not done good. It was severely overpriced, but let's see what the business has done since 2018. Right here is the first couple of quarters that they reported back since going public, and they were doing $247 million in revenue during that time. Okay, awesome. Now let's keep on going along, and it's went from $247 million in revenue, and it's went up basically every single quarter, and now we're doing $598. To go from practically 250 to $600 million in revenue is already a huge ramp up. That's over a double up during that time. Well, okay, you might be saying, revenue doesn't matter, Jordan. It doesn't matter about revenue growth. All that matters is profitability. That's really what investors have to look forward to. Absolutely true. Let's go ahead and take a look at that. During these original quarters when they went public, they were doing anywhere from about 50 to 100 million in free cash flow every single quarter. Now, if you look at these $50 million numbers, they're unimpressive, and they continually grow from around 50 up to around 200 to 250 million per quarter. If you look on this on an annual basis, this is when it really becomes apparent. They went public in 2018. If you look from 1.39 to 2.32, that's almost a double up. That's a significant increase. But that's the revenue. Let's look at profitability. Profitability, 359 million up to 762. That is over a double up in just the last 5 years. So you can see revenue growth. Which direction is it going? It's going up. Profitability. Which direction is it going? It's going up. And more importantly, each and every quarter, this is in a very unique position that the stock price has gotten so low that management has started to aggressively buy back shares. They floated around 400 to 410 million shares ever since they went public, and then they finally announced a huge share buyback program late 2020 where they went from 420 million, and then they went down and down and down, and now they're at 352. And as of the most recent quarter, they're buying back about 7% of the business every single year. Just in the most recent quarter, they bought back about 2% of the company just over the last 90 days. So basically, this is what I see. You see a company that continually grows. They're growing their revenue. They're becoming more profitable over time as the free cash flow keeps growing. And this company is in a really unique position because not only are they becoming more profitable by the day, increasing their return on capital employed, margins, gross margins, operating margins, all those good things are trending in the right direction over the last several years and are continued to expectingly do so, but the company is in a unique position that it can buy back roughly 8 to 10%. Honestly, if they want to be aggressive, it could probably be as high as like 12% of the company's stock every single year. But not only are you getting high single digits to low double digits share buyback plans, you're also getting revenue and profitability growth that is usually in the single digits to double digits as well. But beyond all of that, forget everything. Look at the company's valuation, $7.35 billion. Here's what's so cool about this. The company is projecting $840 million in free cash flow this year. Now keep in mind, that's already a significant increase from last year at 762, which they increased despite the recession. But let's go ahead and take a look at this. You can see that right now $7.35 billion is what they trade at. They're projecting $840 million in free cash flow. Okay, well, the price of free cash flow, based on the 2023 free cash flow estimates that are projected by the company this year, is an 8.75. This company is trading at an 8.75 price to free cash flow. Do you know how insanely low that is? That is ridiculously low. There are many other tech companies that trade at fractions of the price. Just so you know, If we go ahead and take a look at Salesforce, which was my largest holding. Now, I do think in many ways Salesforce is a way better business than Dropbox. Go ahead and start by saying that right there. It should trade at a higher valuation. In my opinion, I think that Salesforce should probably trade in the low 20s price of free cash flow. Probably anywhere around a 22 to a 24 price of free cash flow is probably the average. Right now, based on today's roar up, they trade at a 25. Now, don't get me wrong, while they are a better business, a 25 is miles away from an 8. This company trades in the 8s. And to just basically use some common sense here, forget everything I said about metrics, numbers, valuations. Long story short, the company's been public 5 years. The stock price has done nothing but go down. Go down for 5 years straight, while the business has continually gone up. Every reason in my bones makes this company say, wow, they should probably be a lot higher in share price. Even if you put a multiple, instead of 8, if you put a multiple of, say, 12, 13, then that means that this company should go up significantly from where the stock price is today. I think it is very likely that 1 year from now, 2 years from now, this could definitely be a $30 to $40 stock. I think it is an easy money stock because not only do I think they'll keep growing, but even if I'm wrong, they're going to buy back around 8 to 10% of the business anyway, and that's what I'll get just to hold this stock. So that's what I get to look forward to. That's why it's the largest position in my portfolio, and I'll make dedicated videos to all the companies that I bought and sold in this most recent month. I'm very excited about my performance. I am excited about the overall trend that the portfolio is going. We're breaking records and we're reaching $50,000, which is a definite far cry from where we were 3 years ago in April of 2020 with our initial investment of $1,500. Thank you guys so much for watching. Check out M1 Finance if you haven't already and get up to $100 for getting signed up. But thank you all for watching, and I'll catch you all next time.